it's Nancy from Nancy Chu Homes, and everyone wants to know, is the Federal Reserve going to continue this interest rate witch hunt that they've been on? And, yesterday was a really big Fed day, and let's see how we can read the tea leaves of the speech that Jerome Powell left behind for us. First of all, let's start with buyers are desperate for homes, and they're looking for more inventory to choose from. Sellers are looking for lower interest rates so that they can list their homes and attract more buyers off the sidelines for their house. So look, the truth is, buyers want to buy, sellers want to sell, but everyone's a little bit gun shy and totally dizzy from the out of control race up the internet rate mountain that the Fed has been pushing us through. And for goodness sake, they're still kind of, pushing us through it. We're 17 months in and we need some answers on how this whole thing is going to shake out. Is it going to be a soft landing or is it going to be a hard recession? Listen, when you get a chance, can you please take a moment and comment, and subscribe to our channel so that we can continue to reach consumers who are interested and want to know more about the direction real estate is headed in. Thank you very much. So today, I'm going to talk about the 3 things that the Federal Reserve admitted that they didn't know was going to happen when they started the interest rate hikes. Plus, we're going to talk a little bit about what this means for, just ordinary people like you and me in 2024. Oh, hey, if you get a chance, take a moment, pause the video, go down to the comments and tell me what you think 2024 is going to bring. Soft landing or hard recession? Welcome back to our video about the 3 things the Federal Reserve admitted that they didn't know was going to happen when they started the interest rate hikes. First, let's remember, the Federal Reserve only has 2 mandates, right? And the first one is keeping Americans employed, so jobs, and keeping inflation low. So given the fact that these are the factors, as long as they're all moving in the right direction, then the Fed has, thank goodness, opted not to raise interest rates again in November. Whew, that was great. But there are some things that they really just weren't prepared for. And let's talk about those now. And by the way, if you stay until the end of the video, I'm going to tell you what I think is the most unexpected thing the rate hikes have caused and how this can affect you, the consumer, the American, the person just trying to live a decent life, right? The first thing that the Fed admitted they didn't know was going to happen when they started the rate hikes was, they did not expect mortgage rates to be as high as they were, and yet the economy was still in hot growth mode, right? 5% growth. Yeah, financial conditions are just a lot tighter than maybe we had expected. But the journalists in the room during that interview, they were not backing down. They were pretty adamant. They want to know, how does Jerome Powell feel about inflation moving down even while the economy is growing at above trend? This is not what's expected. You don't normally expect this to happen. Usually higher rates tamp down economic growth, but we're kind of seeing the opposite. He didn't really have much to say about that. But let's look at the second thing that the Fed admitted that they didn't know was going to happen when they started to raise interest rates. Well, it was that the job market was going to remain strong throughout. The Fed has this idea, right, that a bigger labor supply is better because it means that working folks will get paid less. And if you get paid less, then you won't spend as much money. And if you don't spend as much money, then demand will go down and the costs of goods and services will come down or at least stabilize. Yeah, this is that wage spiral fear, if you've ever heard of that. The more money in the system makes it more expensive, so let's take money out of the system. Look, I'm not going to get political here because this isn't the forum to do it in. But I am going to say that I don't know that I ascribe to the pay people less, it's good for them because we know better philosophy. But we are finally seeing some trends in labor that point to it slowing down. The job quits data, see the chart here, is finally back to some pre-COVID levels. Now, this means that less people are quitting their jobs because they're moving to bigger, better paying jobs, right? More lucrative positions. Now, this is anecdotal, but I will tell you in the last couple of months, I've had clients who are entertaining new job offers, but ultimately decided that, they were going to turn them down, but the incentives just kind of like weren't there to justify them uprooting their lives and their families. So as opposed to the last 3 years where, oh my goodness, we had a steady number of relocations because every time you made a job change, you get this like huge bump in salary, right? The third thing that the Fed has admitted that they did not know was going to happen when they started the rate hikes was that existing home sales were going to be forced into an all-time low. All right. I believe the official quote was something like, gosh, we didn't know that high interest rates would discourage people from selling their homes. Ugh. Yeah, car sales are up. New home sales are up. Retail spending is up. Existing home sales, bottomed out. Yeah, it's nice to see that they finally figured out that an 8% mortgage rate was going to impact the housing market. I mean, how many times have you heard one of the Fed board or presidents say, housing remains strong, housing is recovering? Well, one look at the new purchase application data numbers and you know that housing has been severely affected. I mean, we're talking about this is a very rate sensitive industry. Check this out. New applications, all-time lows. So sadly, the Fed could care less about the housing market in crisis because they really want to slow it down. And please do not think that they target high home prices. That's not the filter which calculates, inflation for them. Their true target is what they call rent inflation and owner's equivalent rent, which I complain about all the time. Don't forget, the shelter calculation for personal consumption is based on a survey, a phone survey, managed by the Bureau of Labor Statistics, where they pick up the phone and they ask people, hey, how much would you have to pay if you were renting that home that you own right now? Yeah, that number is not going to be super accurate or anything. What do most people think? My house is a palace and I would have to pay thousands if I were renting it. Well, I think we all know that number is inflated because you're asking people to evaluate the value of their own homes. Yeah, accuracy is apparently not a question here. Look, the truth is the most unexpected thing, and I think you should come to this conclusion by now from all the pieces that are putting together this puzzle. The most unexpected thing that's happened with these rate hikes, the convergence between the largest generational cohort looking to buy a house because they have come of age, right? In conjunction with, the discouragement of equity buyer sellers from listing their homes. It's produced housing inventory at all-time lows, which means home prices are at an all-time high. I know this seems incredibly counterintuitive. You would not expect super high interest rates to coexist with the highest house prices. I mean, check out some of these headlines, right? People who are looking to sell their homes right now are actually looking forward to multiple offers, great terms, top dollars for their homes right now. And those sellers who are willing to buy a property that is below the median for their target neighborhood after they sell their home, there is opportunity to be had here. That high interest rate hasn't stopped people from buying. Because I hate to say this, but I think everybody knows that in the next 2 years, that interest rate is going to come down and they can refinance into a lower monthly payment. Thus the creepy phrase, and I'm sure you've heard it, marry the house, date the rate. Yeah, the Fed definitely did not anticipate continued rising home prices, but that does make sense since it's not part of their inflation filter. All right, look. If you are on the fence about what to do with an investment property or a home that you own and personally live in, I want you to fill out the form that's in the description. We can help you kind of evaluate and audit what your next steps will be as you try to figure out what your real estate and investment needs are moving forward, all right? And in the meantime, if I've given you something to think about or you've learned anything new, please help us spread our reach. Like, comment, subscribe, and you can always get in touch with me directly, 917-992-3098. Yes, that is my cell phone. Or through various social media. Here's the graphic. Thanks a lot, everyone. And I'll talk to you next week. Oh, what's the final thing here? 50-50 on the fence. 2024, starting to look like not so soft a landing. All right? Don't forget, the Fed had originally said that we were going to be in a recession in 2023, and that isn't technically what's happened. But 2024, if they continue to raise rates, which I think they have left that door open to do so, if they feel the economy is just growing too much and jobs are remaining too strong, then yeah, I think they're absolutely going to keep raising those interest rates, which means 2024, my forecast, bit of a recession. All right, guys, see you next week.